Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you a nice, what I call it, cycle low reversal. So this is CRM, and you can see it's had a big sell-off from, this swing high that it had back here in November, about 267, down to the current low that we had. It hit right here in the December the 2nd. So we're currently, you can see this consolidation phase. It's been going sideways, kind of churning, building this lower case or lower base of support. And then you can see it just started to turn to the upside. So we had right here, you can see my pointer, it's what we call a cycle reversal. And then we had the second step that we look for is cycle 1, 2, this histogram here being positive, and then I like to look at my 4-hour cycle 1 and 2 positive, and then I've got a special moving average cross that I like to look at right here with the orange arrow and the blue arrow. So this is a good trade setup with a good potential probability of going higher. So a couple different ways to trade this, and one really kind of clean way to do it is with a call debit spread, but then I'm going to add a vacation hedge to the trade because, as everybody knows, we're going to be having a holiday here this week. We'll have Friday, and then Saturday, Sunday will be closed, so kind of a 3-day weekend, and we can kind of hedge off some of the risk by selling a credit spread against it. So let me show you the trade setup. So we did two different setups here today on CRM. One was calendar, but the other one was a kind of a low cost trade doing just a call debit spread. So we bought the 230 a little bit earlier in the day today. This was going for about that. This was about the 230 strike was about a 50 delta. So we bought the 230 and sold the 235. So this is the 31 December. So not this week's expiration, but next week, and did that $1.90. So $100 or $190 per spread. So that's the total risk on the trade. Now next week on Thursday, the 31st, if it closes above our strike here, the 235, this will be up $310 per spread. So if you do one spread, you make $310. You did 10, you make $3,100, but your risk is defined 190. Now the other thing is that you can see it's got a negative theta. So if it's just to sit here going sideways, you're going to be starting to lose per day. So what we'll be looking to do tomorrow, either Wednesday or Thursday, and especially if we get a nice little pop to the upside, we'll be looking to sell the 31 December, probably a 20 delta short strike. So today this was like a 17 delta, the 242.5, 247. So $5 wide credit spread there. So for 46 bucks. All right. So that reduces your risk by 46, but it also gives you positive theta. So if the market just churns here, say for the rest of the week or into next week, let's say to next week on the 31st, you still would make $34 based on the positive theta of the trade. Now, next week on the 31st, if it goes out between your short strikes and your spread, this will be up $356 on your risk of 144, and that'll be over 247% return. So a really good way to set up a nice defined risk trade, but then also hedge off some of that trading theta decay that would happen over a long weekend. So I hope this helps. Good luck trading.